Stocks our strategists feel are poised to deliver positive returns are featured now in their top stock picks of the week.
Hey, Kevin Cook here with this week's top stock picks. My pick is Splunk. So I thought I'd start off by showing you a long-term price chart here so you can see the damage done. This is the bear market we're in for technology and a lot of other things, but especially the high-flying technology stocks. You see here that Splunk, SPLK, is back to levels that we haven't seen since November of 2017. And you see the launch after that, so the stock finally gets above 75, 80, and goes up to 220 in the year 2020. This is sort of indicative of what happened in those 3, 4, 5 years. That I published an important essay in November of 2017 called "The Technology Supercycle," about why inflation was so low and productivity was so high, but you didn't see it in the government data. So that I'll put a link on the YouTube video here for the Technology Supercycle article, so you can review that. But that's what we had. We had investors paying egregious valuations for these companies based on growth, based on potential for M&A, and now we're back to 2017 levels for Splunk. Now, does that mean it's a good value? Well, we've got to look at the sales numbers to verify that. Before we do that, I just want to review the thesis for owning Splunk has always been, this is a company that looks for hidden data, what they call dark data. Every company has log files with trillions of bits of data that they're collecting about their customers, about their machines, their factories, transportation, marketing, you name it. Companies have tons of data that they can collect, but it remains dark because they don't know how to access it and how to basically mine and model. That's the alliteration I like to remember: mine and model, because that's what a Splunk does. It gives corporations the hardware, the platform, the software platform, to find their data and then do stuff with it, whether it's about machines or marketing. And the estimates are that globally, 55% of data is dark. But they got a stat down here. So yeah, here's what percentage of data is dark. And you can find this paper on their website, or you can find a PDF just by searching Splunk dark data, and you'll get the top results. So 55% of an organization's data is considered dark on average, but they did a survey and found that 1/3 of respondents estimated that 75% of their organization's data is dark. So they've got all this data and they can't even find it and use it. So that's what Splunk does. It helps them do that. All right. So let's look at the sales estimates for Splunk. Zacks number 2 rank right now. And this is a $12 billion market cap company. So that's where we want to go, is we want to see what is the price to sales valuation metric. Okay. This year, which this fiscal year ends in January, is going to see 26% top line growth to cross 3.35 billion. Pretty healthy. And next year is projected to hit 4 billion, which is still 18% growth. Now, at a 12 billion market cap, 4 billion in sales, that's a 3x price to sales ratio. In the industry, that's cheap. That's an attractive valuation, because right now you're seeing all these valuations get clobbered. Remember when I used to talk about NVIDIA trading for 20 times sales? Now NVIDIA is trading under 10 times sales. And but you've got other high flyers still, like CrowdStrike is a premier endpoint security company that trades over 10 times sales. So Splunk is a relative value in a space where valuations have come down to about an average of 6 times sales on average. So Splunk is cheaper than the average SaaS company. And remember, what makes the SaaS model work is the recurring revenues, right? When they get corporations who are buying subscriptions out 1 to 2 years, and some of those are paid Some of those are paid up front because that's the deal. If you look at CrowdStrike, that's what makes CrowdStrike powerful, is that their cash flow is so strong because of their annual recurring revenue. So let's look at profits and why Splunk became a Zacks number 2 rank. It is profitable. Profits surging back from the Corona crisis, where they had a loss. This year, they're going to do 84 cents per share. That's 167% turnaround. And here's how the analysts reacted after their last strong quarter. You can look at this here, the detailed estimates. This column right here, they took this year from 18 cents up to 84 cents. That was because of a big beat, which got applied. And then, but even next year, now there is some concern about a slowdown in recurring revenue of like 250 million for next year, but analysts still raised estimates. So that's the story on Splunk. You can see here was the big beat, why 124% EPS surprise, and that's why this year's estimates had to go up so much. But the key is how much next year's jumped. You can see up here again from 68 cents up to above $1.50. Was it? Yeah, above $1.50. So, all right. So that's the story on Splunk. The relative valuation compared to the rest of the SaaS space, whether it's security or data mining and modeling, is extremely attractive. If you're going to pick one up, I would pick up Splunk. All right, thanks for joining me this week in Top Stock Picks. Next up is Dave Bartosiak.
Well, thanks, Kevin. I've got another Top Stock Pick of the Week for you. It is Zacks rank number 2 by Primo Water, ticker PRMW. Let's take a look at Zacks.com and see why I like it. Primo Water is a Zacks rank number 2 buy. We've got a B for value, A for growth, F for momentum, to help it round out with a VGM composite score of B. The utility water supply industry is in the top 19% of our Zacks industry rank. Water sounds pretty boring, sounds pretty recession-proof to me, my friends. Not that we're worried about that sort of thing. A couple of things to look at here. First off, the PE a little bit richer than the broad market's 16 times earnings at 19 times, but well off the industry average of 30 times. Last quarter's EPS surprise was 31% to the upside. Keep an eye on this when it reports before the bell, November 10th. Are we already talking about November? Wow, this year is really scooting along. Sales estimates current year, 7% revenue growth. Next year, 4.5%. But look at how that translates over to EPS growth, 23% for the current year, 17% for next year. So those are pretty good. Now let's take a look at my favorite chart on Zacks.com. Of all the charts that you can follow for the long term, the price consensus and EPS surprise chart here. Now, the black line corresponds to the right y-axis, which is the price. The multicolored lines represent the evolution of our Zacks consensus estimates, and that corresponds with the left y-axis. Here you can see also these green arrows, earnings beats, red arrows, earnings misses. So we're coming off a couple of big beats here. Notice how you had sort of this downside action in earnings estimates, followed along by a downside trend in the stock. What's happened recently? Well, we have a little bit of an uptick here in earnings estimates, both for 2022 and for 2023. So you would think that the stock should be trading back above that 14 level, right? But it's not. So that, my friends, is what I like to call divergence on the price consensus and EPS surprise chart. One of my favorite things to see. Earnings going this way, a stock that went this way. Eventually, this starts to catch up with those earnings unless the earnings tick on down. So when I see that sort of divergence, that tells me I'm in a good place to be. So there you have it. That's my top stock pick of the week. I want to thank Kevin for coming on and giving his great idea. And don't forget to check out Zacks.com/promo for this week's upcoming promotion on Surprise Trader, ran by one of the most handsome devils at Zacks. For Kevin, me, and everybody else here at Zacks.com, I'll say thank you so much, and we'll see you all next week.